Ever wonder why stock markets around the world seem a bit shaky lately? Today, we're diving deep into global stock market volatility in 2025, explaining what's really going on and what investors like you can expect next. Let's break down these big financial ideas into something super easy to understand. Why markets are shaky. So, why are markets feeling nervous? It comes down to a few big reasons. First, geopolitics. Think of it as global drama impacting our money. Tensions between countries, especially in the Middle East, like the Israel-Iran situation, cause a ripple effect. When things get heated, stock values can drop quickly. It's like a short-term shock. Historically, markets often dip by about 5 to 6% before they start recovering once things become clearer. A big part of this worry is oil. If there's a problem around places like the Strait of Hormuz, which is like a superhighway for about a quarter of the world's oil, prices can shoot up. We've seen oil prices jump 4 to 7% in just a short time due to these fears. Also, attacks in the Red Sea mean ships have to take much longer routes, making everything from your clothes to your electronics more expensive because shipping costs go up. Oil and your wallet. The inflation connection. Let's talk more about oil and how it hits your wallet. When oil prices spike, it directly impacts inflation. Think about it. Gas costs more, which means transporting goods costs more, which means your groceries and products cost more. A $10 increase in a barrel of oil can add about 0.1% to 0.2% to inflation. This is why central banks get nervous. If inflation gets too high, they might keep interest rates high for longer, or even raise them, making borrowing more expensive for everyone. So, who wins and loses when oil prices are wild? Companies like airlines and cruise lines often lose because their fuel costs go way up, but big energy companies like ExxonMobil and Chevron can actually benefit because they make more money from selling higher-priced oil. Also, defense companies often see a boost when global tensions rise as countries spend more on security. Inflation's sticky side. Inflation isn't just about oil though, it has other sticky parts. In the US, for example, wages have been growing faster than inflation. This is good news for your paycheck, as you have more buying power, but it can also contribute to prices staying high, especially in service industries like restaurants or healthcare. Then there are tariffs. These are like extra taxes on imported goods. When a country puts tariffs on products from another country, those products become more expensive for consumers. This also pushes up inflation. And finally, global supply chains are still a bit messy from past disruptions. Things like natural disasters, port congestion, or even geopolitical conflicts can make it harder and more expensive to get products from one place to another. This means higher costs for businesses, which often get passed on to you. So, with all this uncertainty, what should smart investors do for the next year? What smart investors do next? First, don't panic sell. History teaches us that when there's a big geopolitical shock, markets usually dip for a short time, maybe a few days or weeks, and then recover. Think of these dips as pit stops in the market's longer journey. Institutional investors often buy the dip, patiently adding to their investments during these downturns. Second, diversify. This is super important. Don't put all your eggs in one basket. Spread your investments across different types of assets, different industries, and different countries. For example, US stocks are quite expensive right now, so looking at international markets can be a good idea. Third, consider safe havens and defensive investments. These are assets that tend to do better when the market is volatile. Think of gold. It's like a financial shelter in a storm. Also, short-term bonds from stable governments like US Treasuries are considered safe. These can offer good returns without too much risk. And what about stocks? Look at defensive sectors like utility companies or basic consumer goods companies. People always need electricity and food, so these companies tend to be more stable. Also, the defense sector is doing well because of increased global spending. Fourth, spot the growth opportunities. Even in volatile times, some areas are growing fast. Artificial intelligence, AI, is a huge long-term trend. Look for companies deeply involved in AI development or using AI to grow rapidly. Also, watch out for countries that are benefiting from new trade routes or changing supply chains, like some in Latin America or specific regions in the Middle East that are investing heavily in new industries like renewables. Regional focus: USA, UK, Middle East. Now let's zoom in on our key regions, the USA, UK, and Middle East. For USA investors, the US economy is still quite strong, but its stock market is priced for perfection, meaning stocks are quite expensive. The big challenge here is stagflation, where growth is slow but inflation is still high, partly due to those tariffs we talked about. This makes it tricky for the US central bank. For UK investors, the UK economy is growing slowly and it's facing sticky inflation. Prices are staying stubbornly high, especially due to domestic costs like wages and utilities. The Bank of England has a tough job ahead, and it might be a challenging market for fast growth. And for Middle East investors, this region is seeing strong growth, driven by efforts to diversify their economies beyond just oil, like Saudi Arabia's Vision 2030. While oil prices still play a big role, there are exciting new opportunities in non-oil sectors like technology, healthcare, and renewable energy. Plus, many Gulf countries are strengthening ties with Asian economies. Conclusion. To wrap it up, the global market in 2025 is certainly complex, but it's not all doom and gloom. Remember these key takeaways: stay calm and disciplined, don't let daily headlines trigger panic. Diversify smartly, spread your investments across different assets, sectors, and geographies. Build resilience, include safe havens like gold and short-term bonds. Stay informed, keep an eye on oil prices, central bank announcements, and inflation data. Be selective, seek out specific growth opportunities while being cautious in vulnerable sectors. By staying calm, diversifying, and focusing on quality, investors can navigate this volatile period and even find opportunities. For more detailed insights and to explore the full interactive report, visit the URL mentioned in the description. Thank you for watching.